Hello and welcome to the channel. In this video, we're going to talk about the balance sheet. We also have videos on the income statement and the cash flow statement. Those are in the description below. But today, and in this video, it's all about the balance sheet. I like to think about the balance sheet as kind of like a company's report card, right? It's a static moment in time, and we're really looking at their assets and liabilities and their shareholder equity and all these types of things you're going to learn about in that particular moment in time so we can evaluate a company. Many types of ratios or things that we use as investors to evaluate companies come from these financial statements, including the balance sheet. So what we're going to do is we're going to look at Tesla's balance sheet in terms of learning and walk through each of the line items there quickly for you. When you look for, by the way, for financial statements, you can find them on the company's website, usually under investor relations, but we're going to use Yahoo Finance because it's a nice way that a lot of investors use. It's a free service, and you can use that as far as, walking right through so you can kind of follow along with me if you like. So right now, let's go do some screen sharing, and we're going to learn all about the balance sheet. Okay, I'm over here at finance.yahoo.com, and we're just going to search for Tesla. We're going to look at their balance sheet here. You can type in their name or start typing in their name or just put in their ticker symbol TSLA. That'll get you there. So we'll go to Tesla, and you'll see a quote here for Tesla and the summary and everything. And I want to direct your attention to this ribbon along here. There's lots of great different things underneath this ribbon. And to find the financial statements, like balance sheets, income statements, all that, we're going to go under financials here. And then we're going to go to balance sheet. You got income statement, balance sheet, and cash flow. So we want to look at the balance sheet in this section here. So let's take a look at balance sheet. And you'll see this is the balance sheet for Tesla. And you can look at it either on an annual basis or a quarterly basis. It defaults to annual here. Oops, sorry about that. And so you can see it's got the different years here. Again, balance sheets are looking at a moment in time and a specific moment in time. So that's unlike where you might have, let's say, quarterly numbers for an income statement or a cash flow where they're adding up. These are all individual kind of statements of time. So you can see total assets are higher at this moment in time than the previous two periods. But let's say we want to look at quarterly. We want to see more recent performance. So we can look at a quarterly balance sheet, what the moment in time looks like in the more recent last, 4 quarters, basically. And again, these don't add up. See how these don't add up? They're all their individual numbers. Again, different than income statement or cash flow where they would add up to, let's say, the last 12 months. So here we are at a quarterly balance sheet. And if your first thing is to look at, let's say, your total assets, you can see this number here, 57,834,000. One thing that's important is the numbers are all in thousands. So you'd want to add 3 zeros when you're looking at any of these numbers. So this is not 57 million, this is 57 billion, because we're going to be 57,834,000 and then adding in thousands another 000. See, these are in billions. So if you're looking at a smaller company, it might be in millions, but either way, you're going to be adding in that number. So this is 57.8 billion. And the big 3 buckets you'll want to look at is these 3: total assets, total liabilities, and total equity. And we'll go through each of these in detail. Everything beyond here is, and it can vary on Yahoo depending on different companies, is kind of pulling from these big 3 buckets and giving you maybe information or calling it out more. Like total debt, for example, they're just calling it out versus having you go find it in under total liabilities, for example. So let's go through each of these big 3 buckets that you want to look at. And you want to look at to see what might be trending. How are things going? Our total assets are things, as you'll see, things like cash as an asset. Is the total number going up or going down or staying about the same? And you can see it's gone up a little bit. And total liabilities, which are things that we owe money on, like paying our debts, those have stayed the same, maybe gone up a little bit too. But really, what you'll look down to is what's happening inside these. And then we'll break down what each component is under total assets. Because it's one thing to know total assets, for example, but what are the different components? So in total assets, you have current assets and non-current assets, basically. Current assets are anything that's happening within a year. So it's the key number there is happening within 1 year, or you can liquidate it within 1 year or sell something like, or you can get things like cash, for example, within 1 year. And total non-current assets would be things that might be, you wouldn't sell or take advantage of within a year. So that'll be the same for total liabilities. You have current liabilities, again, things that are happening within a year. You got to pay a bill within a year, versus total non-current liabilities, which might be like long-term debt that you don't have to pay for, 2, 3, 10 years out in advance. But we'll get to that one. So let's start with current assets. So what composes current assets? We got these down arrows. You can learn more stuff about what's going on under each of the arrows. So we know that Tesla in the last quarter has $25 billion of current assets. Of that $25 billion, $16 billion is cash and cash equivalents. Cash is super liquid, right? It's stuff that you've got right now. You think of your own checking account or your own bank. If you have cash, you can go buy stuff with it. And a cash equivalent is something that's as similar to cash. So if you look at Tesla, you'd say, well, this is pretty good. They've got $16 billion of their total current assets is in cash. That's very, very good, very liquid. And all that's really in cash and cash equivalents. They have some other short-term investments. Maybe they're investing in a short-term bond ETF, for example, and that's 30, not thousand, that's 30 million. Remember, it's in thousands. So 16 billion, almost all of that is in cash and really accessible cash equivalents. So that's a good thing, you'd say, on this. Receivables are things like accounts receivable. That's usually what you'll see here. Is just, you won't see other breakdowns. They'll say accounts receivable or AR. That's what people owe you money, right? So if you bought a Tesla car and you put it on your credit card, Tesla would be owed that money. You didn't pay for it in cash. So they're waiting for money to come that they'll turn into cash once those receivables are paid. Now, some people don't pay their receivables, right? They don't pay their bills, right? So that's money that's not as readily accessible as, let's say, cash. But it's money that they're counting on coming in. And that's 1.9 billion, right? Now, something that is current that they can turn over within a year is inventory. And you can see that's a big number too. Now, what kind of inventory would Tesla have? Well, I'm sure you're thinking, well, they have cars, right? Until they sell a car, it's part of their inventory. So you can see they've got $5.1 billion in inventory. Companies like manufacturers would have larger inventory balances here under current assets. Maybe retailers would have a large inventory as they sell through their inventory of soap or groceries, food, whatever it might be. A software company, for example, like maybe like a Facebook, or it's now called Meta, would not have large amounts of inventory because everything's digital. Now, in inventory, you can even break that down further. Again, there's zero. So we click on that, and you can see inventory is basically broken up into three buckets: raw material, work in progress, and finished goods. So if we think working backwards, well, a finished good would be the car is done. If that brand new Tesla Model 3 is rolled off the line and is headed to the dealership ready to be sold. Work in progress means they're in the process of finishing that good. It's still in process. And then raw materials would be just the basic raw materials. It might be, something like metal or rubber, for example. Now, Tesla probably is buying their tires from somebody else, but let's use it as an example that rubber would be a raw material. Putting the rubber on, on a tire would be a work in progress, and then putting that tire and completing the car would be a finished good. A finished good is something that's now sellable. Work in progress means it's kind of in process, and raw material is basic raw materials. And so you can see that $5.1 billion inventory, you can see how those numbers change. And if we were looking at their finished goods, you could say, well, back in December, they had a lot of finished goods, and that number is going down a little bit, and more is going into raw materials and work in process. So if there's let's say delays and maybe some, if it's let's say GM or Ford where they have unions and then they're on strike, you might have a lot of finished goods sitting around or not being done because they haven't turned those raw materials into work in progress. And then other inventory is just other inventories of things that are not, part of that, maybe part of their main line. Maybe it's inventories of solar panels, things of that also, or batteries that Tesla might sell to other people, for example. So that's our current assets, right? We've got all these main buckets of cash, money that we're owed in terms of receivables, and then also inventory. Also in current is prepaid assets. Basically, you've paid in advance for something. So it would be kind of like a prepaid asset, so it's paid in advance. So those are our current assets. Now, those are, again, things that you can turn into money basically within a year. Cash is already a year. You're expecting your receivables to come in within a year. Inventory you're expecting to sell and turn into cash in a year when somebody buys a car. Non-current would be things that, again, are big over a year. And you can see that's a pretty big number too. That's 32 billion of non-current assets. So what's in here? So one of the biggest areas for companies is PPE. Now, you might know PPE from the pandemic, which is personal protective equipment, like face shields, for example. But that's not what we're talking about when we talk about on a balance sheet. PPE is plant, property, and equipment. Sometimes I get that backwards, but basically plant, property, and equipment. And you have your net, which would be your net property and equipment. So if you break that further, you've got your gross. So you can see that those two numbers for Tesla are very similar, right? Their gross and their net, or net after adjustments, is pretty close to being the same, 30 billion versus 36 billion. But if we dig deeper into gross, we're going to see some adjustments to that gross to get to our bottom line net for property, plant, and equipment. So what are some things you have under here? You've got land, right, where their factories are, and they own those land, and they've improved that land. They own buildings, you know, things like that would probably fall under here. They have machinery like robots and other types of welding equipment and things, furniture, that kind of stuff, where the office is, where Elon Musk sits. You know, they have a lot of money in machinery. These are assets. They're worth something. Assets are things that are worth something. And then they have other properties that might not be related to the core of their properties. And then they have, you know, construction that's in process. It's not completed, but it's in process, so there's still value there. So that would be an asset, for example. And you have leases, right? So they're accumulating their leases, and they paid off. This is leases kind of, you know, paid off on their leases. So these are all assets, again, things of value. Now, where you write off an asset, that's depreciation, right? Things, you know, depreciate or get worse over time. That brand new factory you built, for example, is not as valuable maybe over time. Now, some things like land and factories may go up in time, but let's say machinery would be a good example, where that welding machine, you know, starts wearing out over time, and you can depreciate that or reduce its value, and you want to account for that. So that's where they have accumulated depreciation. You can see how much their depreciation, and that's your difference. Look at that 6.2 billion. If our gross was at 36.7 billion, if we take out depreciation of 6.2, now we're at 30.5, you know, approximately, pretty much that's what we're at. So that's where our net property, plant, equipment as a total non-current asset comes in. And that'll usually be the bulk of your non-current assets. Now, there are other ones that are in there, like goodwill and other intangibles. And you can see they've got some for Tesla. Some companies like Coca-Cola has a lot of goodwill. And really what goodwill is all about is things that are hard to quantify. Things like when you have a merger or an acquisition, you know, the difference in the value, you know, which you can kind of quantify versus buying a company. But also things like in there, like goodwill would be things like branding. You know, Tesla has a strong brand. Coca-Cola has a strong brand, and so they're accounting for that under goodwill. Is it as tangible as like a finished car as part of, you know, or a work in progress or a rubber or things like that? No, it's not as tangible. So you want to consider that when you're valuing companies. And then there's other intangible, you know, assets that might not fall under goodwill. This is where you might need to go to the company's, you know, income statements and annual reports and things to get, if you really want to know super deep, like what are they counting as intangible assets. So that's under there, and then also other non-current assets fall in here. Again, Yahoo will give you a nice, good summary stuff, lots of good information. But if you want really fine detail, you'll have to go to the company website and look at their income statements, or excuse me, their balance sheet, where they'll get into the detail. But right now, we can see that, you know, the total non-current assets, the bulk of it is what we expect in property, plant, and equipment. So this is our assets, right? So these are good things. These are our assets. These are things that are worth something. Now we owe money too. We owe things, and that's where we have our total liabilities. And so if we look at total liabilities, that's where you have your same current liabilities, things that are due within a year, and non-current liabilities. This is a good number to look at too. Like, is most of our stuff due soon, or is most of it due later? And you also would like, and this is what, like, where you get ratios and things like for investors, like a current ratio. A current ratio is looking at current assets, you know, divided by current liabilities. So in effect, 25 billion versus divided by 18 billion. And you can see that number would be above 1. It'd be, you know, 1 point something. And you want your current ratio to be above 1.0. That means they have enough current assets, things like cash and accounts receivable coming in, to pay their current liabilities. So current liabilities, very much a mirror of current assets. Let's go under there. So we had accounts receivable. We also have accounts payable, or accrued expenses, you know, or AP, accounts payable. This is money that we owe to other people. So if we're buying tires that are completely finished from Firestone or Goodyear, another company, that we're going to stick on our cars, our Tesla cars, we owe them money. We buy it on credit, so that's an account payable. So that's money we owe. We have to pay within a year, usually even sooner than that, 12.6 million. And other types of, like current provisions or other types of current things that we owe money on. Or current debt. If we go in here, you can see I'll break it up with current payables and accrued expenses, that we're basically accounting for those expenses. But another thing is current debt, right? So this is debt that's coming due. So we have things that we owe as far as we'll pay our suppliers, the tire company, but then we have debt. Maybe we borrowed money, we issued a bond, or we borrowed money from the bank and we need to pay our debts. So that's where current debt would come into. And you can see how they might have current debt like for lease obligations or other current borrowings. So we owe money on our leases, or we owe money to the bank, or maybe we issued a bond and we owe money to our bond holders. Either way, this is money that's currently coming due within a year. And then if we look under here, we also have current deferred liabilities. So we've deferred some liabilities, we've deferred paying things, but now they're coming due. So now we have to pay the money within a year, so now we owe money. So really the key thing under current liabilities is to think of that big thing as being all within a year, right? Everything's coming due within a year, and we want that to be, ideally less than our current assets so we can pay those bills within that. And then also be looking at how things are going, right? If we see, our current payables are going up, but maybe that's because our current assets are going up because we're getting more cash in because we're selling a lot of cars, not a big deal. Then if, let's say we have current debt really rising, then we might be like, all our long-term debt's coming due. We have to be able to pay that, or maybe restructure our debt. But if we go back in time, we can see it's actually going down over time. That's a good sign as far as current debt would be. So we have our total liabilities is made up of current liabilities, and now we also have total non-current liabilities, or things that are due over a year from now. And a lot of that could be like debt and things and long-term provisions, as a kind of a catch-all bucket. But what you'll mostly see is long-term debt and lease obligations. We owe money on if we're leasing out factories. We owe money on things that we borrowed that might be a 3, 5, 10-year type of bank loan or debt. So if we look under here, we can see how that's broken up between lease arrangements and debt, for example, money that we owe. So this is stuff that's not coming due now, but it's something we're going to have to pay in the future. Again, a good sign. Going back in time, they're at 10.8 in long-term debt, and now they've been paying that down and are down to 8 billion, right? This is where you can look at things like cash flow statement and income statement to see, is the money coming in that'll help pay for this, basically. And then you have non-current deferred liabilities. So this is non-current, and this is kind of like, again, you'd have to go to the website or to their detailed one to really look in these in great detail. But things like tax liabilities, taxes that we owe that might not be current or coming due soon. Or current deferred revenue. Maybe we've deferred these taxes, or we deferred that revenue. This is a little deeper accounting stuff, but either way, we're not realizing this type of things coming in a year is basically what's happening. Preferred securities, other non-current liabilities, this is all things that fall into that long-term provision bucket. So again, liabilities, just like assets, are made up of current assets, liabilities, and current liabilities and non-current liabilities. The magic number is 1 year. If you take these two numbers, the 57.8 billion and the 29.9 billion, the difference between total assets and total liabilities, that is your total equity, or your total equity and gross minority interest, but really that's your total equity. That's what's left over. That's what goes to us stockholders. This is the value of the company, basically saying, okay, our company, essentially is one way of looking at it. There's other ways of looking at it, but you could say, okay, we have a total equity of 27.8 billion. Again, we'd like to see that number go up, and it has. So that's why one reason Tesla stock does well is they're continuing as a growth company. If we break that out, most of that's going to be in stockholder equity, right? We own stock. Now, there's some minority interests and different things too, but you can see it's such a smaller number compared to that 27 billion of stockholder equity compared to 836 million. That makes up that total would be 27.889. If we dig a little deeper, you can see that almost all that is capital and things that's money that's been raised by selling stock, basically. and then there's retained earnings and losses and different things that affect that number. These different gains, losses that affect that number. But basically, you're looking at that total that net stockholder equity as part of that total equity, right? And then you adjust a little bit for minority interest. But again, this is common where 27 billion of that, of the 27.8 billion, is in what we have as stockholder equity. And the key is that's the difference between assets and liabilities. So these two numbers will then, assets minus liabilities will equal equity. These three are the big three you want to look at. And then this is just all extra stuff that you kind of highlighted or automatically pulled by Yahoo Finance, or some things that some people really like to look at. One thing that people like to look at is working capital, right? You might hear the term working capital. And again, you can just kind of see where the numbers go. You can really start adjusting that number a little bit, but working capital is looking at your current assets. Simply, it's your current assets minus your current liabilities, right? So we can see our liabilities, have been going. Our current liabilities, let's go back to that, have been going up. See how the current liabilities have been going up. So because our current liabilities have been going up and our current assets have stayed the same or gone down a little bit, if we look at our working capital, we can see that reflected, going down from 12.4 billion to 6.9 billion. We'll call it maybe 7 billion. So those are just another ways of interpreting the numbers in the big three categories you want to look at, in here. This is just pulling out more numbers from there. And things like total debt and all that, that's just coming right off. If you were to dig deeper, they're just into total liabilities, you can find your total debt. They're just kind of pulling these numbers out so you can find it real quickly. Things like tangible book value is an interesting thing too, where people look at like the price of a stock to its book value, or P to B. Well, what is the tangible book value? What is the company kind of worth? You look at your total assets minus your total liabilities, which is that stockholder equity. That's part of the total book value calculation. And then that 27.8 billion is adjusted down a little bit further by intangible assets and that goodwill. Remember that goodwill was kind of this kind of branding, a little bit more of an intangible number, just like intangible assets are intangible numbers. They're not as hard a number. So if you want to say, well, I don't want to look at that total gross equity, that's nice, but I want to pull out those, I don't want to say made up, but a little bit more estimated type numbers. You don't know what a branding is worth until you sell the company, for example. Well, that's where I can get to my tangible book value and take out intangible assets and goodwill. And I could say, so for the hard type stuff, the real tangible stuff, company's really worth as far as a book value, 26 billion. And is that number going up? Yes, it is quite a bit over the last quarter. So there you go. And that's a good sign, again, versus a company whose tangible value would be going down. So there you have it. That's the balance sheet as far as looking at the balance sheet and the key things within there that you can start digging into that. And it's things that come off the balance sheet that are used in things like ratios and other things that investors would use to evaluate a company. So the key is your assets and your liabilities, and the difference between the two is your total equity, which you're pretty much are looking at total stockholder equity, or things, if we're an investor, what we get to keep. All right, I hope that really helped you out. Go ahead and check out the videos on the income statement and the cash flow statement to kind of continue your learning around the financial statements. By the way, if you like learning about this type of stuff or just learning about investing in general, hey, do consider hitting the subscribe button as well. With that, I encourage you to look at companies that have financial statements that interest you and keep your learning going. With that, I wish you all the very best of luck.